Nothing at all. Nothing at all.
Is the microphone working okay right now?
Yep.
Okay, perfect.
Was it the on button? I'm just kidding. I just did.
The mute button.
Okay, sounds good. Well, we'll go ahead and get started, and there might be a couple more who join us later, but this is a really great group. Just looking at who's here right now. I know a lot of y'all are probably familiar with Michael, so I won't do a long introduction, but Michael is Managing Director of FoundersAdvisors Healthcare Practice. Has over 20 years of experience advising healthcare clients on just a range of fundraising strategies, including IPO and public and private equity, among others. So really happy to have him here today. Before I hand over the reins to today, I just want to encourage anyone who isn't already to be aware that our conference is coming up in April. I'll get that website up soon, but we have some really great speakers, including Melinda Richter from J Labs, who's going to be our keynote. And we're going to have some really, I think, vision casting sessions, including breakout sessions on space bio and opportunities there, and ag tech. And we're also going to hear from some founders of BioAlabama about kind of the state of the industry when BioAlabama started and how that compares to today and where they can see the future of the industry. So I'll hand it over to Michael right now, but thank you guys all for being here.
Okay, thank you. Look, my plan is to speak for about 20 minutes. If at any point along the way you'd like to ask a question, feel free to jump right in. I think this always works better if we ask the questions as we go, but we'll reserve some time at the end to address any questions that anyone may have. I'm going to go ahead and share my screen now and get the presentation pulled up. I do know and recognize some of the attendees in the call today, so it's a pleasure to talk to you all again. There. But like I said, if there's anything either before or after this you'd like to talk about, feel free, jump right in or email or call me. I'm happy to jump on the phone and talk healthcare at any point. As Rachel said, I am a longtime healthcare investment banker. I've been in healthcare finance my entire career, with the exception of doing a stint as a chief financial officer of a specialty pharmaceutical company. I've effectively been an investment banker now for over 20 years. I've covered a lot of different sectors in healthcare. Especially pharmaceutical company, we raised a bunch of money in an IPO and ran a phase 3 trial, which was unfortunately not successful. That's why we run the trials. So I know a little bit about everything healthcare, but biopharma, biotech, life sciences is really what I've done the most of. I started my career on the large pharma M&A team at Bear Stearns in New York. And that is one of the groups that has put together some of the largest pharma and biotech mergers and continue to do so at various different banks now. And so any time I have an opportunity to talk bio or biopharma, I'm happy to do it. I won't cover the slides that talk about FoundersAdvisors. These are available and you can look at them at your leisure. But we are a lower middle market investment bank designed to help companies in their search for liquidity in whole or in part in terms of finding a partner. We are active in the mergers and acquisitions market. We now have 8 separate industry coverage units at Founders across industries. Like I said, I cover healthcare, but the thing I guess to kind of highlight as I start the presentation is 2021 has been the biggest year for mergers and acquisitions in the history of corporate mergers and acquisitions. And we anticipate that December, over the back 2 or 3 weeks of this year, will continue to eclipse the record levels that we saw in 2015, which was heretofore the biggest year on the M&A front. What was driving that? Valuations are really right now at an all-time high. I'll talk a little bit about why they're at an all-time high, why we think these valuations will continue into 2021. And this is really, I guess, the four things that we are really kind of focused on and watching as we turn to 2022. Number one, I should probably change that to just say COVID. And that way I won't ever find myself out of date when I present the slide and there's a new variant that we're concerned around. So anywhere where you see Delta, change the concern to Omicron. But the point remains, there's still, despite all of the progress that we as a nation and we as a world have made in controlling and working to minimize the negative impacts from the coronavirus or COVID, there's still a lot that we don't know. And I guess we learn something new on a daily basis as to how much or how little we don't know. One of the things, I guess the second thing we're really paying attention to is what and how acquirers are paying or funding these acquisitions. A lot of larger transactions from the public side have been done with stock. Even in healthcare, which is really counterintuitive, particularly if you look at the amount of cash that pharma and biotech have on their balance sheets. And it's not just cash that's that is sitting in a foreign market for a tax jurisdiction issue and you can't repatriate it. That's less of an issue these days. But this goes back to the point around COVID and the uncertainty surrounding it. Cash as a piece of, as currency has become more valuable, and it from a corporate finance standpoint brings into, I guess right now, some questions around how you actually think about what is the capital asset pricing model and the weighted average cost of capital for companies. It's less of an issue in the lower middle markets because debt financing still remains fairly cheap. Leverage has remained reasonable, and the amount of leverage that is being utilized in acquisitions is a healthy amount of leverage. And that's one of the contributing factors as to why we continue to see multiples at or near all-time highs, despite the sectors. And so I guess I've touched on the valuations. The one main question around valuation sort of ties back into number one and two. As we look to 2022, inflation is a real issue and a possibility that there is 5+% inflation in 2022, particularly as we think about how the Great Resignation continues to play out as part of finding employees, how much you're paying employees to fill vacant positions. Can you fill these vacant positions? That's one of the, I guess, most unforeseen, at least in my opinion, secondary or second derivative effects of the COVID, dealing with COVID over the past 24 months is what's going to happen with labor, because it's causing ripple effects throughout the economy. The Fed is very focused on it. And look, as long as we can, I guess, control and have a controlled growth of inflation, I wouldn't expect the price or the cost for debt financing to widen any more than it has currently. But that's the real question mark on valuation. It's less about taxes, which is number 4. It's what's going to happen with inflation and how is that going to affect the borrower's cost of capital when you start thinking about leverage. One of the contributing factors as to why the M&A market in 2021 was as I mean, honestly, crazy as it has been, was taxes and what's going to happen as we shifted administrations to particularly the capital gains tax rate. You know, a lot of deals that didn't get done in 2020 slipped into 2021, but a lot of owners were considering, really for their tax planning, estate planning purposes, what's going to happen. You know, at one point there was talk that the Biden administration wanted to increase the capital gains tax rate from 20% to something approaching the ordinary income tax rate of 39.6%. You know, that's been backed away. There is still some uncertainty around where capital gains tax rates may settle out, and it may be something that honestly doesn't get done until well into the first quarter of next year. But it's going to, we're not going to see a vacuum or a void of deals in the first quarter like we might have. And so we're going to see a more easing, and deals that are not getting done in December of this year are being delayed and not being postponed. With that said, let's talk about where M&A activity is occurring. I think the transactions that you see, read, hear about are all obviously in the Wall Street Journal, multi-billion-dollar transactions. But as I guess the tagline says at the top of the page, 95% or 94% of the deal volume over the past decade has been less than $500 million in total enterprise or deal value. And one of those reasons is because private equity has become a much larger percentage of the actual acquirers. 20 years ago, there was private equity. Private equity did deals, but that industry was brand new 20 years ago. And they effectively had their choice in terms of out-competing strategics for deals of any size. As more and more dry powder, or money that has been committed to private equity firms, has come into the market, it's caused private equity firms to look up and down the value chain, to be the value chain or the size of company, to be able to find, I guess a less competitive marketplace, or a market that is not as competitive. And so private equity has come down in size. You can see it on this page. The number of deals that are under $100 million in terms of value continue to make up the vast majority of the transactions. And if you look, 2020 is an outlier because of the impact from COVID. 2021, that only includes the first 2 quarters of this year. And so, you know, in 4 months, when we update this slide, 2020 or 2021 will likely have, you know, a larger portion of deals under $100 million. It's anticipated, I guess, by us than in any of the previous years. And, you know, that the total deal volume under $500 million overall is going to be well north of that $30 billion mark. What's driven the activity in 21? I've talked some of this, taxes, but really private equity businesses looking for a less efficient marketplace have come in and driven a lot of value. There have been more deals available, and so you've seen a little bit of a flight to quality in terms of buyers having a little bit of their choice in terms of where they wanted to spend their available time. And so I think You may see in the first half of next year, multiples come in some as processes that were scheduled for launch in the back half of this year, but would have been competing for time, whether it was with a strategic buyer or with a private equity buyer, have been delayed. And you'll see those deals start to get done in the first half of next year. And they may be done at lower enterprise values or lower overall multiples of value, EBITDA multiples, revenue multiples, because those assets were probably judged by either buyers or the sellers as to have, as to be less competitive in the marketplace. And so they will be delayed. But I think that will be a temporary downturn or downtick in the multiples that you see paid in the first half of next year. This slide speaks to the proliferation of private equity. I'm not going to spend a ton of time on this one. The one thing I will say is that private equity now has well north of $1 trillion in dry powder. That's capital that is committed to a private equity fund to be invested. If you found or start a private equity fund, you have to put that money to work in order to be able to raise the second fund. And so that is one of the reasons we've seen multiples stay elevated, is that there is a competition among some private equity firms to keep putting that money to work. And that putting that money to work and raising new funds continues to push to the growth of dry powder. And you can see that really on the bottom right quadrant of this page. Overall market trends. Economic growth prospects, despite the Great Resignation, remain robust and people are optimistic. But for inflation, I think people will see and believe that 2022 and beyond are going to continue to perform. Equity markets continue to work. There are returns that are still being, there are returns in all of the equity markets that are still outpacing what maybe some of the fundamentals would lead you to believe. Headwinds, again, there's another Delta variant in that bottom right-hand quadrant. I'll have to change that slide. Supply chain and labor shortages, those are contributing to our concerns around inflationary pressures. That's really the biggest headwind. And you can see in the top right quadrant on this page, the Federal Reserve is focused on this, and you can see really how and where the rate hike survey is showing the Fed to be leaning. But you should expect higher interest rates in order to help deal with inflation. But I think the composition of the Fed as it sits now, in my mind, is positive in terms of how much credit I would give them for how they're going to be able to handle and deal with inflation. Another slide on dry powder. You can see, based on this slide, the pace of private equities fundraising is continuing to accelerate, and really, even in 2020, did not miss much of a beat. That's both of these slides talk about the dry powder that's available, how it's growing in terms of a compound annual growth rate. And look, with private equity continuing to be able to raise funds to put to work, continuing to have to put those funds to work for business owners and entrepreneurs, those are all positive factors. Even if an exit or finding a partner is not something that you are considering today, the growth in the private equity industry is good for us all, and we will continue to see benefits from that for quite some time. Credit quality still remains strong. look, finding returns on the credit side has really been has been a fairly easy job, because we haven't seen, despite really the initial March, April, May, June of 2020, I guess, impact from COVID, we really walked through that fairly well as a national economy, but particularly but as a world economy as well. And so credit quality remains strong. Returns on the credit side have been fairly easy for those, whether they are portfolio managers or commercial bankers or leveraged finance lenders to come by. And so that continues to contribute to the overall low interest rate environment in which we are operating. And this is my last slide. Really, multiples across healthcare sectors are at an all-time high. I believe, particularly now that the capital gains tax rate issue looks like it's going to be one that was muted, and cap gains tax rate will likely settle in at 28-ish%. That's going to contribute to both an ongoing supply and an ongoing demand for quality assets in the market, not just for private equity, but for strategic buyers as well. I think, as we continue to learn more and better how to handle COVID from a health perspective, but also from an economic perspective, and you see larger strategics once again return to using cash, more cash and less stock as the percentage of the currency that they are using in acquisitions. As we see some of this play out in 2022, I anticipate multiples to remain where they are effectively for the next year to 24 months, absent any sort of exogenous shock on the market. On the right-hand side of this page, and really the bottom left quadrant as well, size is important in terms of valuation. The bigger the company, the higher the multiple that gets paid for that company. And that's simply because valuation is a function of risk. But I'll pause after I kind of walk through that bottom right quadrant, the valuation drill down, and I'll open it up for questions. What the bottom right quadrant attempts to do is across, 4 size buckets to normalize for what are the most important factors that figure into valuation. And so where it says PEG/corp seller, that's that middle column. That's to say is if you are buying an asset from a private equity group or outside of a corporate, you would expect that group to have a better management team or have a better set of policies and procedures that contribute to making that company particularly perhaps less risky than an independent or a privately managed company. What it shows is that's not necessarily what plays out. What the post-closing management is, if you've got a professional management team, and that's the management team that's going to be in place after that acquisition, is that the most important factor in valuation? And it's more important than if it's coming from a corporate as a carve out or if it's coming from a private equity owner. But the most important is the column that is shaded in gray and says above average. That is for above average financial and human resources related controls. If you have those in place and you are able to document them, this drill down, this analysis shows that in the end, you will ultimately be rewarded more so for those and the ability to demonstrate it than you would for any of the other three factors. And so particularly for younger companies, the one word of encouragement I would leave you with is to start early in terms of your policies and your procedures and your financial controls. Document the KPIs or key performance indicators that you are tracking and keep a record of that because it's worth real money. And, you know, a half turn or a full turn of EBITDA, you know, going from 6 to 8 times or 7.5 times EBITDA, that can be real money at the end of the day. And so that's really sort of my last and final takeaway on this page. And with that said, I'll open it up for anybody who has any questions.
Thanks so much, Michael. I have a couple questions, but I'm going to be quiet and let our audience ask their questions first.
Hey, Michael.
Hey, Bob.
Thanks for doing this. This last slide's really interesting, and it's helpful to hear about how factors that impact multiples. I'm wondering, because healthcare is such a broad term and encompasses so much, do you have any insight on sectors within healthcare? You know, biotech, pharma versus life science?
So I do. I think really for assets of this size, that top right quadrant is probably the best place to start. And it's going to be less dependent on what sector you are in. And it's going to be more dependent on the other characteristics of your company and how it relates to other available investment options within that industry. And what I mean by that is, what does your margin profile look like? If we're talking about a $10 to $25 million enterprise value company at the top right quadrant, you know, so the average right there is 6.2. If you have what does your margin profile look like? What does your historical growth profile look like? What does the customer concentration look like? What does what do your future growth prospects look like? Those are all things that would contribute to move from what I would say is kind of a 6.5 baseline EBITDA multiple to a 8.5 EBITDA multiple. And look, as you get bigger, you know, going from $2 to $3 million of EBITDA to $3 to $8 million of EBITDA, you're worth more because 3 to 8 is further away from 0 than 2 to 3. And that just because valuation is really a function of risk and the certainty of the future cash flows associated with an asset. And so it's less about what sector and how a particular sector trades at even all the way up to what I would say is $250 million worth of enterprise value. It's more about what are the individual characteristics of this company that make it differentiated from other potentially available investment opportunities.
Great, thanks.
You're welcome.
Hey, I had a question. This is
Okay.
AJ
Hi,
Singhal,
AJ.
CFD Research. Hey, so I was wondering, with all this dry powder that you were mentioning, has that increased the tolerance for risk in any way, or do you see any increase in like funding for maybe earlier stage companies in the pharmaceutical arena, like, you know,
So
more maybe
yes,
like,
it has increased the tolerance for risk. It has increased the tolerance for risk. So, and you can see some of that. Let me go back to this slide. You can see some of that where multiples across industries have trended up, and not just within healthcare over the last 5 years, 10 years in particular. If you were to take and look at this EV to EBITDA on the bottom left quadrant of this slide, and you were sort of to break down and look through probably years 2010 through 2015, you would be able to see a more appreciable uptick in those multiples over time. And I think one of the things that's a little bit lost on this slide is just the scale, and it's a little bit crowded, but you can see, particularly in the smaller assets, multiples have continued to tick up from what is on the $10 to $25 million range and the $25 to $50 million range, from what is below 6 or right at 6 to 6.0 and 6.9. And that translates into, I guess, an overall broader risk tolerance. And you see that in more venture capital type investments. When you talk about private equity, and I talk about the dry powder, that includes venture capital funding as well. And so that includes that sort of segment of private equity within that. It's a little bit tougher to show because there are fewer multiples. There's less that you can put a multiple on when you're talking about early stage funding for pharma or biotech, but you can see it by the number of ideas and the number of earlier stage things that are being funded rather than things that are less. And honestly, the size of some of the raises that are being committed to things that are, you know, further away from the clinic than historically.
okay. Do SBIR does having SBIR funding, does that help with the risk factor, or does that kind of provide some, you know, added confidence in the, you know, technology?
Yes,
and
I would say it does. I wouldn't say you wouldn't have to have it, but it does act as sort of a secondhand or third-party validation of some of the controls that are in place. And the other signal that SBIR provides is that that's non-dilutive funding. And I think it's a signal to either current or future investors of the strength of the management team, also because it's non-dilutive funding and it's financing that acts as, you know, sort of a third party validation of some of the policies and procedures and controls that are in place.
Right. Okay. Thank you.
You're welcome.
Michael, I'm going to jump in here. Just kind of thinking about the drug pricing legislation that's looming. How do you kind of speculate or anticipate that will affect specifically M&A activity, valuations, future cash flow associated with specific assets, or deal rate over the coming months? I know there's a lot in there, just whatever you think is important and applicable would be
Yeah, so I think the taxation, the concern about the taxation and the changes for both corporate and personal taxes in April, May, and June of 2021, we sort of had people expecting the worst case, which was, a tax regime that was going to be punitive across the board for as wide a swath of the economy as you probably contemplate. And that prompted a lot of activity in terms of owners, who may have been previously considering, is now the right time? I don't know if now is the right time. Maybe I'll go another year or two and see if I can grow the business some more on my own. It prompted a lot of people to say, well, if capital gains tax rates are moving from 20% to 40%, that's effectively a 25% reduction in cash after tax proceeds. And you would have the amount of time it would take you to be able to grow into replacing that in terms of enterprise value is probably a 3 or 4 year time frame. And so you saw a lot of business owners either come to the market or seriously think about putting their company up for sale in the back half of this year. If that had come to fruition, what I believe we would have seen is an almost shutdown in the M&A market, at least for the first half of 2022. And while we don't exactly know how it's going to play out exactly, the impacts are going to be much more muted. And so you're going to see a gentler drop in terms of the number of transactions that are being done in the first quarter of 2022. And I think by the time we get to the second quarter of 2022, we will be at the most normal market we will have been in since, pre-March 6th of 2020. And it will have taken sort of 2 years almost to the day to get there. But we'll be back to what I think will be a more normal course in terms of the amount of activity. And I think that's good for everyone, because I feel like some assets in the back half of this year were being unfairly penalized or ignored by the broader market, just because it was a crowded marketplace. And you saw, even for earlier stage companies that were more reliant on venture capital type investing, the second half of 2021 was a tough time to get the attention that you needed, because third-party service providers in the terms of in the form of lawyers, accountants, regulatory diligence providers, quality of earnings providers on the accounting and finance side, all of those third-party providers have been, just about as busy as they have ever been. And so that's trickled down or trickled across into other asset classes that are less reliant on M&A and more reliant on VC for a funding source. And so I think we'll see some of that working its way through in the first quarter of this year. And I think we'll be in a more normal course market in the second quarter of 2022.
Thank you. Anybody else have any questions? 3, 2, 1. Okay. Michael, thank you so much for coming today. Really appreciate it. I think this is really informative, and there was a lot of interest in it from some.
I really enjoyed it.
All right. Well, we'll talk to you soon.
All right. Thank you, everyone. If you have any further questions, want to talk to me offline, my email address, I think, is on this presentation, but you can get it. Feel free to email me or call me. I'd love to talk to anyone about anything at any time, healthcare related. All right. Bye.
Bye.